Hello learners, welcome back again. I, Dr. Alpa Ghosh, Assistant Professor in the Department of Management. Today my topic is Venture Capital. It is a part of financial services. Let us start with the meaning. Money is provided by investor to start a business that has strong potential of high growth and profitability. The provider of venture capital also provides managerial and technical support. Venture capital is also known as risk capital. So in nutshell, a venture capital institution is a financial intermediary between investors looking for high potential returns and entrepreneurs who need institutional capital as they are yet not ready or able to go to the public to raise the finance. The concept of venture capital is like that. In broader sense, venture capital refers to the commitment of capital and knowledge for the formation and setting up of companies, particularly to those specializing in new ideas and technologies. In our country, venture capital comprises only seed capital, finance for high technology and funds to turn research and development into commercial production. In broader sense, venture capital refers to the commitment of capital and knowledge for the formation and setting up of companies, particularly to those specializing in new ideas or new technologies. In Western countries like the USA and UK, venture capital not only consists of supply of funds and financing technology, but also supply of capital and skills for forecasting the growth and development of enterprises. Thus, venture capital is not merely an injection of funds into a new firm, but also simultaneous inputs of skills needed to set the firm up, design its marketing strategy, and organize and manage it. If we come to the characteristics of venture capital, we can see that it is basically financing of new companies which are finding it difficult to go to the capital market at their earliest stage of existence. This finance can also be loan based or in the form of inconvertible debentures. Venture capital aims at capital gain due to the success achieved by the concern that borrows the funds. It is a long-term investment. The money invested in venture capital has to be repaid after a long time. Venture capital take part in the business of borrowing concern through their equity participation. Venture capitalists contains risk as they fund mostly to the risky and technologically high or advanced projects. It involves financing mainly to small and medium-sized enterprises. The dimensions of venture capital, we start with the first stage of development of a firm. It is the development of a new idea for delineating precise specification for the new product or service and to establish a business plan. The startup stage is the second stage of the firm's development. In the third phase, the firm has made some headway, entered the stage of manufacturing a product or service, but is facing enormous teething problems. In the last stage of the firm's development, when it stabilizes itself and may need, in some cases, establishment, finance to explicit opportunities of scale. So these are the four stages in which there is a deep requirement of venture capital. The functions of venture capital is growingly becoming popular in different parts of the world because of the crucial role it plays in fostering industrial development by exploiting vast and untapped potentials and overcoming the threats. Venture capital provides finance as well as skills to new enterprises and new ventures of existing ones based on high technological innovations and ideas. In the development stage that follows the conceptual stage, venture capitalist develops a business plan which will detail the market opportunity, the product, the development and the financial needs. The venture capitalist has to access the intrinsic merits of the technological innovation, ensure that the innovation is directed at a clearly defined market. Therefore, venture capitalist helps the firm to move to the exploitation stage, that is, launching of the innovation. In each investment, as the venture capitalist assumes absolute risk, his role is not restricted to that of a mere supplier of funds, but that of an active partner with total investment in the assisted project. The venture capitalist fills the gap in the owner's funds in the relation to the quantum of equity required to support the successful launching of a new business or the optimum scale of operations of an existing business. Venture capitalist roles extends even as far as to see that the firm has proper and adequate commercial banking and receivable financing. Now the question comes, how does venture capital works? So the financial market, the providers of venture capital, they are known as venture capitalists, and the capital can be offered by venture capital firms, investment banks and other financial institutions, and individuals with high net worth. Who are venture capitalists? As we have seen, the term venture capitalist is induced in venture capital. So, venture capitalists are those people who invest in early stage companies having promising futures. They invest mostly through equity participation. A venture capitalist can be a sole investor or a group of investors who come together through investment firms. So, when should one go for venture capital funding? There are three stages when we may require venture capital funding. It may be at the stage of expansion. It may be the requirement of strong mentoring. So, with equity participation, the venture capitalists are also giving their know-how, their skills, their knowledge, their expertise to the organizations who have borrowed fund, and mostly at the time of competition when the firms feel that their financial requirement is more to meet out the competitive advantage. Next topic is types of venture capital, and venture capital can be categorized as per the stage in which it is being invested. Generally, we are talking about following 6 stages or 6 types of venture capital funding. It is seed funding. At the stage of startup capital, it may be first stage or first round when you have ideas but you don't have money to start with the manufacturing process. It may be expansion funding. Existing units go for expansion, diversification. It may be later stage funding when already you are established and now there is more requirement of funds. And the last one is bridge funding. Bridge funding is mostly your short-term funding when you don't have excess of long-term funds, so you try to meet it with the short-term funds. Coming to the disadvantages of venture funding, the first it is reduction of ownership stake, because the venture capitalists, they are also becoming the partners in the organizations where they contribute. So, the existing owners, there is a reduction of ownership stake. They give rise to a conflict of interest that actually they are working for the venture capitalist or the profit is for the real owners of the firm. Receiving approval can be time consuming. There are a lot of compliances, formalities, documentations which are to be completed. So, this may take a long time. And the last but not the least, availing venture capital may be challenging because you may not find a good network within yourself. To obtain funds from the venture capital, you should have a good credibility in the market, a good reputation, and moreover, a good network with the people who are the providers of venture capital. So, that's all from my side for the day. Thank you.